Hello guys, welcome to this 12th lecture of the economy crash course, and in this video we'll be discussing about bad loans and the steps taken by RBI to handle those bad loans. Bad loans simply mean non-performing asset. What is a non-performing asset? We have discussed the basics in the previous videos. So we'll be discussing the advanced developments in the current affairs in the past couple of years and also what economic survey talks about this issue. We have discussed that in 2013-14 RBI ordered banks to carry out what is known as an asset quality review. After that, RBI decided to give a series of steps to get back these loans. Firstly, banks were advised to carry out those measures which would probably help the companies to rectify their methods and help them in repaying the interest. If that doesn't work, the second concept is restructuring. That is, either the interest is reduced or time period is increased for a longer tenure so that they have more time to pay back the interest. Specifically, these are the schemes which were a part of this restructuring packages that RBI offered from time to time. It is not important to go into the specifics because most of these schemes are now defunct. Most important one amongst them is the 5 by 25 scheme that was given to the infrastructure segment. It is not important to get into the details of this, so let us move on. If restructuring also does not happen, then RBI directed the banks to do whatever is in their control to recover whatever amount they can using two main laws. That is the SURFACE Act, and in 2016 we had the Insolvency and Bankruptcy Code, which we'll be discussing elaborately now. Moving ahead, the pandemic struck us in 2020, and it is obvious that the cash flow would stop for a lot of companies, and it is in this context we have the KV Kamath report, which was talking about 26 sectors that were suffering because of the pandemic. So KV Kamath committee has ordered or suggested rather to restructure the loans of the various companies in these 26 sectors. It is not important to remember these sectors. So just understand that KV Kamath committee is about restructuring of loans in the pandemic time. It is important to remember the time period also. Now let us go back to the SURFACE Act, which we were discussing about recovering the money. That is, obviously at every step when we are discussing this 3R strategy, at every step the focus is on recovery, but selling away the assets of the person who took the loan or the company that took the loan is the last option, because it is an additional energy, as well as it requires additional money for the banks to recover that money by involving in this process, this recovery process. So in order to give a legal sanction to the lenders, that is the banks or the financial companies, in 2002 an act called the Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest, in short SURFACE, was created with an objective of extracting whatever money is possible from the borrower. So what happens is, when a company is unable to pay the loan back, let's say the loan taken was for 100 crores for example. Now this company might be having certain buildings and other machinery worth, let's say, 20 crores. Now if the company is not in a position to pay back this 100 crores, the lenders will now have an ownership over this building and other machinery and try to extract maximum possible value from this 20 crores so that the loss is minimized. So this is the objective of SURFACE. In order to carry out this, the primary business of banks is not to resell the assets of different companies that they give loans to. So for this purpose, there are certain companies called the asset reconstruction companies, which was created under this SURFACE Act. So if there is a question in prelims, what is the legal sanction for asset reconstruction companies? It is not the Insolvency and Bankruptcy Code, it is the SURFACE Act of 2002. Now, recently in the pandemic, we have seen a rise in non-performing assets. Obviously, asset reconstruction companies would become all the more important when there are non-performing assets. In this time period, a committee was set up called the Sudarshan Sen Committee to look into the issues that were faced by these asset reconstruction companies in attaining their objective of maximum value extraction. So this reforms, if there is a question in prelims, what is the objective of Sudarshan Sen Committee? It is to look into the issues of asset reconstruction companies. It is not important to get into the details. Now, going back to this original issue, that is the SURFACE Act. How can an asset reconstruction company do this? So, as you know, the objective of an asset reconstruction company, it gets a legal sanction from this act. It will try to liquidate the assets, that is, sell off the assets and recover maximum possible money from the borrower. But if the borrower feels that he needs more time to pay off this loan, or if he wants to appeal, because appeal is something that is very much a fundamental element of justice and judicial processes. So he will appeal in what we know as debt recovery tribunals, which were again created by the SURFACE Act. So he will obtain a stay order from the debt recovery tribunal. Now, even in that, if he loses, there will be a debt recovery appellate tribunal at a higher level. But the problem is, if the person wants to use this facility of DRAT, he should at least give 50% of the money that he is due to the banks. Now, why is this provision there? To avoid silly complaints and stop the recovery process. So, this is the SURFACE Act. But look at the larger problem here. The bank is actually lending 100 crores, but just getting 20 crores. There is a loss of 80 crore rupees in this case. Now, why would a bank want to be in this kind of a scenario? Ideally, if the loan is restructured or if it is given time, and if there is a possibility that, let's say, instead of this 100 crores, a 90 crore value can be at least returned, it is an ideal scenario, right? So banks would prefer this kind of a scenario rather than just going for 20 crores in an ideal scenario. But that is not possible in SURFACE Act because there is no mechanism to extract maximum possible value apart from just selling of the assets. Now, if we have to restructure and get this 90 crore value, you need to fundamentally understand the business model here. Now, let us take the famous example of Kingfisher. If banks were to run this Kingfisher business and extract maximum possible value, it would not be doing a banking business. It would rather directly get involved in this Kingfisher business itself. So, SURFACE Act was having a fundamental problem of not allowing restructuring as a legal measure. Remember this point, we'll get back to this later. Now, who all can use the SURFACE Act? All the banks, all the housing finance corporations, and some NBFCs. What is this list? It is not important to get into the details. But the fundamental value proposition that they're bringing is very poor. That is, poor value is being realized. So, restructured loans are not possible, like we have discussed. So, we needed a solution that has a legal backing, because it would be questioned in courts if there is no legal backing. And therefore, in 2016, NDA government came up with this Insolvency and Bankruptcy Code addressing all these issues. So here, the people who give money, they are called creditors. Two kinds of creditors are recognized: operational and financial. Financial means directly the banks or the financial institutions which give money. And this is very important, operational creditors. There can be a lot of people working in an organization that is about to go bankrupt, like the employees, managers, or if, let's say, for example, if you are in a construction business, it so happens in a construction business that we get all the raw materials or the bricks, cement, etc., as a form of credit. There can be an agreement between the buyer and the seller that at a future point of time I will be paying back that money. This is how normal businesses would work. But what if this construction project fails? They'll also face money crunch, right? So what about them? Till now that was not recognized, and for the first time Insolvency and Bankruptcy Code has recognized these operational creditors. So as per this code, what happens is, like we have discussed in SURFACE Act, there is no possibility of restructuring. To address that, the first thing that this code proposes is setting up an insolvency professional whose main work is to ensure that the business is revived. So there will be a committee of creditors. Sometimes it so happens that all the people who give the loans may not be a single person. Like in this case, there can be operational creditors, and even in the case of financial creditors, there can be 3 or 4 banks. So the person can take loans from different banks, and if the business fails, all the banks are affected. So there will be a committee of creditors, and they will form together and they'll go to the National Company Law Appellate Tribunal, which is set up under the Companies Act. And if there is an insolvency petition, an insolvency professional will be appointed, and there will be a committee of creditors. Now, what is the composition and their voting power will completely depend on how much loan that their voting power will depend on which bank gave how much loan. Let's say, for example, if 66% of the loan is given by SBI and a bank like ICICI gave 33%, the voting percentage will also be in this same percentage. Now, if the committee of creditors gives a go ahead to the plan which was proposed by this insolvency professional to maximum revive this company, which is called the corporate insolvency resolution plan, simply put, a resolution plan, the process will kick off. After some time, if the business revives, these creditors would take their money and exit from that, or simply move ahead with the insolvency or complete bankruptcy and sell off the assets. They will just focus on recovery, just like in the case of SURFACE. In short, insolvency professional will use his business expertise to revive this company to the maximum possible extent. Now, if we have to question this, what is the appeal structure as per Insolvency and Bankruptcy Code of 2016? If there is an individual or a partnership company, they will have to approach the debt recovery tribunal. If it is a company, they will have to approach the National Company Law Appellate Tribunal. So just remember this for your examination purpose. However, remember that there are certain ineligible borrowers. Who are these ineligible borrowers? Willful defaulters. Let's say, for example, Nirav Modi. He was considered a willful defaulter because he had the money to pay back, yet he was not willing to pay back. And secondly, incapable defaulter. So as per the legal definition, if a non-performing asset remains a non-performing asset for more than 1 year, they cannot approach the insolvency professionals under this IBC code or the IBC. Directly, their assets will be liquidated as per the SURFACE Act, which we have discussed prior to this. In 2019, this Insolvency and Bankruptcy Code was amended twice. For the first time, the time limit was increased. One of the major problems with SURFACE Act was that the average time was nearly 4 to 5 years, and this is too long a time for banks to wait to recover their money. Now that time period, as per the Insolvency and Bankruptcy Code, was brought down to 270 days. That time period was considered too less for Indian standards, and therefore after this amendment it was made 330 days. Because if we take a look at the Insolvency and Bankruptcy Code cases that were happening, this is the rough time period that they were taking despite the best efforts. Now, the second amendment in the same year was about giving more weight to Insolvency and Bankruptcy Code. So there were certain steps which ensured that only serious complaints were encouraged. Now, it is not important to remember the trivial details of what those steps are. However, at the same time, important thing that you have to remember is government decided that the spirit of Insolvency and Bankruptcy Code is maintained. Now, what is the spirit? If a company is not in a position to pay the loan back, it is not always the case that they are escaping. There can be genuine reasons also. So the spirit of IBC, like we have seen, is to resolve the problems of the company and extract the possible value. So it is giving an opportunity for the companies to revive. It is not to punish but to revive. But there were certain steps which were taken in the middle, like say for example cancellation of the business license, which would obviously create obstacles for revival of that company. Let's say a company X took loan and wants to exit out of that, and the insolvency professional will try to sell this company to a person Y. Now if the license itself is cancelled by the government, why invest in this business, and how is it possible that the company revives? In order to address these issues, the government, through law, an amendment, reassured the insolvency professionals and the entire ecosystem that no such retrograde steps would be taken in the further days. The amendment was passed with certain provisions. At the same time, another worry was a lot of companies had heads who were involved in criminal cases. In the same example, if the company head is involved in a enforcement directorate interrogation, and if enforcement directorate is actually threatening that they would take over the assets of this company owners X, then why would a person Y invest in this company? Because he's at a very significant threat of losing his entire money by investing in such a company. So a law was created saying or reassuring that criminal immunity will be there for new partners after restructuring. This issue is famously addressed in newspapers as the Section 32A of IBC 2016 amendment. So it is important to remember this. Now let us understand the latest developments and the proposed amendment bill which is yet to be passed in 2021. So you have to understand that any business owner would not want to sell off that business or get into a loss. And this is all the more important in the case of MSMEs, which have a lot of regulatory challenges as well as practical challenges in our business model. They would not want to sell off their companies and get into this bankruptcy mode. This is very important for MSMEs, and the rising uh, insolvency petitions for MSMEs has made the government uh, recognize the importance of this pre-packs. Now, like we have discussed, the spirit of IBC is always reviving the company in the maximum possible manner. So, this pre-packaged mechanism for MSMEs was supposed to be the central point of this Amendment Bill 2021. So, here what happens is, like we have discussed, if we want to initiate proceedings according to the Insolvency and Bankruptcy Code, the first thing is we have to file an IP petition or the insolvency petition in the NCLT. That is when the NCLT would appoint a insolvency professional and the entire process would kick in. But imagine the trauma that MSME owners who created a business with so much passion, due to certain unforeseen circumstances like COVID, they would have to face humiliation in the market. So their reputation will be at stake. And not every MSME is a bad business. There will be certain genuine cases also. So this pre-packed mechanism will give room for safeguarding the prestige or reviving the company which is under stress. Here, this process is not taken to the National Company Law Tribunal, and it is a out of court settlement within the ambit of the Amendment Bill 2021. So instead of the usual 330 days, within 120 days, there should be a mechanism to come out of the debt. So how is it exactly different from the usual process if it is still involving an insolvency professional? So in the normal CIRP, that is the Corporate Insolvency Resolution Plan, there is a possibility of change in management. Here that is not there. There is no change in management, and even the committee of creditors, that is the committee of all the banks that gave money to this borrower, they will also, even before giving loans, as per the agreement itself, they'll get into an agreement that in case of a distress for their debt, they will enter into this pre-pack mechanism. So also there is no need for court approval. Like in normal case, we will have to go to the NCLT, right? Here there is no such need. Everything is pre-decided. So in short, the insolvency professional will act as a mediator. One more additional advantage that we have in this is the spirit of IBC, which is maximum recovery, is made possible by another method also. That is the Swiss challenge method. Now, what is the Swiss challenge method? So, usually, when the insolvency professional puts forward a plan or a offer out in the market, there can be sometimes unsolicited offers also. That is, some company X came to know about the distress that this company is in and wants to invest in that company. They can approach this insolvency professional. So it is the job of insolvency professional to maximize the value for the company. So what this professional would do is resort to this Swiss challenge method. That is, he or she might advertise that there is a company X which came out with an offer to invest in this company A, which is under stress. So, if there is a new company Y which can give a better value than this X, the project will be awarded to them. So, if X wants to retain this project even after Y came up with an offer, they will either have to give equal or more than what Y offers. That way they can retain this project. So value realization will increase through this Swiss challenge method also. So this is one more advantage and the details of prepack. So some more information about the Insolvency and Bankruptcy Board of India. So this is as per the IBC 2016, that is the Insolvency and Bankruptcy Code 2016. Basically this is an office which is under the Ministry of Corporate Affairs. So what does it do? It selects the insolvency professional agencies. We are talking about insolvency professionals, right? So these professionals should be certified by certain agencies, or they should pass certain examinations to be certified as insolvency professionals. Now, which organizations are worthy of conducting this examination is decided by this IBBI. As of now, there are three different agencies which can give the certificate of a person worthy of being a insolvency professional. So they can either be the chartered accountants, so ICAI, which is the body that conducts this chartered accountants exam, is one such body. Company secretaries, they are also recognized as insolvency professionals. And then we have the Institute of Cost Accountants, and they also certify professionals as insolvency professionals. So these are the basic points that you have to know. In the last 3 years, what did the economic survey talk about this performance of IBC? In 2019, it talked about the reduction in non-performing assets because of the behavioral changes involved in the companies. They are much more law abiding and the compliance standards have increased. And in 2020, the time period, which was usually 4 to 5 years when SURFACE Act was there, has been reduced to less than 1 year, which is a very positive development. And in 2021, taking into consideration the COVID pandemic, the economic survey talked about the importance of learning from our past. It used a term called regulatory forbearance. Now, what does this mean? What does this regulatory forbearance mean? Simply put, when there is a distress, regulation will be taken easily. Like say, for example, when there is global financial crisis in 2007, 2008, the non-performing assets started increasing. But this regulatory ease should have ended in 2011 itself. But no steps were taken by RBI as quoted by the economic survey, and this created a historic rise, that is 17% of the bank assets turned non-performing assets by 2018 because of this delay in uh, regulation. They have to tighten the regulation after the crisis passes. Now, if we learn from our past and not repeat the same mistake in the future, insolvency and bankruptcy code will become a very powerful weapon for our Indian economy, according to our economic survey. And back in 2020, economic survey talked about the importance of PSBN, that is the public sector bank network, which is nothing but a office which can act as the fintech hub, that is the financial technologies hub, to discuss about the credit worthiness of the borrowers. Similarly, another important factor is there is a committee called M. Diostali Committee, which suggested that RBI comes up with a digital public credit registry. This is nothing but a database, so that this database is available for all the financial stakeholders to assess the credit worthiness of the organization. Now, how do banks assess? There are various organizations like, say, for example, CRISIL, etc. It is fragmented and present across the ecosystem. There are many more. We can't remember all those details, but the fact that a digital public credit registry will act as a one point source is suggested by Deostali committee can be asked in prelims examination. Cross border insolvency is one more concept that we have to know, which the survey deals in the 2022 edition. So basically, if an organization or an individual borrows from different banks of different countries and invest that money in different countries, and this business goes bankrupt, so this is a very peculiar situation. Banks from different countries are involved, that person is in India or that organization is in India, and the assets are again invested in different countries. So what is the legal architecture available to deal with this scenario? What does the Insolvency and Bankruptcy Code say in this regard? In this scenario, IBC is actually falling short of expectations because it only addresses the problems of corporate debtors. What happens if individuals actually give these loans? What is the legal architecture available? This is actually the scenario for a lot of companies involved in this peculiar situation of cross border insolvency. In this context, the survey says that India should adopt this UNCITRAL common law, which is helpful in dealing with cases related to international trade. Once this is adopted, there will be common regulations, there will be common standardized procedures for insolvency professionals from various countries, and they'll be able to participate in the legal architecture of different countries freely. Two other steps were also taken in this scenario to extract maximum possible value and reduce NPAs. One is the legal entity identifier number, and second one is the Fugitive Economic Offenders Act of 2018. Now, LEI, what is this? Let's say, for example, you have a borrower like Nirav Modi who is accused of conducting a fraud in Indian banks by using fake documents to get loans. Now, Indian banks have blacklisted him. He's not going to get loans from India or any financial organization in the country because of the blacklist. But at the same time, if international banks are not aware of his credit history, they can be cheated as well, which is bad for the entire ecosystem. So, in order to avoid this problem, the Financial Stability Board suggested that we use a global level identity called the Legal Entity Identifier Number. It is sort of an ID card at a global level, and this should be mentioned in all the loan documents. So this way, it will avoid frauds across the globe. And the nodal agency which is dealing with this LEI is Clearing Corporation of India, just a fact that you have to remember. Don't get into the details. Now imagine the scenario if a person like Nirav Modi took a loan or participated in a fraud and left the country with that money. This Fugitive Economic Offenders Act 2018 gives the power to confiscate the properties that this person has in India, not just in India but also overseas properties. He will be given a time period of 6 weeks, and if that person is not appearing before Indian authorities, those properties can be captured. And these powers are given by the special courts which are functioning under the legal ambit of the Prevention of Money Laundering Act of 2002. Now, all said and done, it's quite possible that banks may still not recover this money. And how do banks work? through depositors' money. But what if depositors don't recover that money? It is a serious problem because most of the depositors are common people who cannot survive without this. They cannot survive such huge financial blows. So, what about the depositor safety? Isn't it RBI's mandate as per the RBI Act of 1934 to take care of depositors also? Here is where there are certain steps taken by the government. So, for this purpose, to safeguard the depositors, there is an act called Deposit Insurance and Credit Guarantee Act. Let us talk about this first aspect of deposit insurance. So, as per this mandate, every commercial bank should take a license from a body called the Deposit Insurance and Credit Guarantee Corporation, which is set up under this act. And its main job is to sell insurances to the banks. So, if a depositor deposits certain amount of money, his money is insured up till 5 lakhs. Let's say if the person deposited 5 lakhs in his account, he'll get 100%. But if the depositor invested 10 lakhs, he's only going to get 5 lakhs and he will have to wait for the remaining 5 lakhs till RBI intervenes and the lengthy process of resolution happens. So this 5 lakhs was previously just 1 lakh and there was no time period. So 2021 amendment to this act has increased the amount from 1 lakh to 5 lakhs and settled the time period at 90 days. Within 90 days, they will get that 5 lakh if something happens to the bank. So depositors' money is safe. Now you might have to wonder, why is this a credit guarantee act also? You can see that this is the Deposit Insurance and Credit Guarantee Corporation. Now, what is this Credit Guarantee Corporation? Take a look at from the banker's perspective. Banks have priority sector lending. Let's say, according to the norms of RBI, 18% is supposed to be given to the agricultural sector loans. Now, it's quite possible that they have a bad monsoon and the crop fails. What about this money? So, the Credit Guarantee Corporation will repay this PSL loans, and that is why this name, Credit Guarantee Corporation. However, remember that this facility is not available for NBFCs because the working model is completely different. They are not catering to simple companies, they are working for large corporates. So they are taking a risk very voluntarily and they borrow money not from public but from banks itself. So banks will have to bear this risk. So this is not available for NBFCs. Remember this fact. Our economic survey talks about NARCL. Now let us understand this concept also. So in 2017 itself, the idea of bad bank was proposed in the survey. Bad bank means a bank which is big enough to handle bad loans or non-performing assets. We saw that in 2002 itself, through the SURFACE Act, ARCs were introduced, but they were not big enough to handle large portfolios. Like say, for example, if the loan worth is 10,000 crores, private companies may not risk such risky investments because it is quite possible that the company that itself is handling this 10,000 crores project is not able to perform in that budget. Obviously, ARCs might not have the expertise to handle such projects, even if they are getting the 10,000 crore worth asset at, let's say, 2,000 crores. This itself is a very huge amount of money. Now, public sector banks would obviously want to sell this off, but the problem is there would be election, and during elections, opposition parties might allege that the ruling party is colluding with the public sector banks and is involving in corruption with capitalists, industrialists, etc. Even though if that is not the scene. To avoid all such controversies, NARCL was proposed and it was created along with another wing called IDRCL. So NARCL plus IDRCL together constitute the idea of bad bank. What these companies do, like say this part of the company is set up with the help of public sector banks. Public sector banks obviously want their loans back, so they would be capitalizing or they wouldn't mind funding an organization which will take care of this NPA headache for them. At the same time, if capital alone can solve the problem, government would obviously involve in the process. It would also require expertise. So this expertise would be present not with the banks but with the market or private players. So for this reason, IDRCL is not a government body, but it is a private body where 51% of the ownership is through private investors. So what happens is PSBs will capitalize this NARCL. Let's imagine this with an analogy. Let us imagine uh, a person bought a plastic container for 100 rupees and expected to use it in the certain packaging and generate value out of that, but that business did not work, and he expected 200 rupees return for using this plastic, but his business failed and he was just about to lose everything. But he borrowed this 100 rupees, and the bank that gave this 100 rupees is trying to extract maximum possible value. So banks, what do? Just like a person who is selling his waste products to, let's say, old newspapers are there in a house. Those old newspapers are sold to a person who recycles this material. Let's say that person bought it from you in bulk, and this person sells it to a person who has the expertise, let's say Y, to recycle and use it for a better use. So a person who recycled this will obviously have some value because he is putting in a lot of effort and skill to reuse this material. In a similar manner, if a company is buying this bad asset, the NARCL would hand over that asset to IDRCL, and IDRCL, using its private expertise and all the skills required, will revive this business and gain maximum value out of it. After that, the lenders would gain certain money back, or they will ensure that the maximum possible value is extracted from this dead asset without any public hazard, because there is a government company involved in this situation. So this is the concept of NARCL or IDRCL. This is a very important development. With this, we completed the issue of non-performing assets in our economy. What is the efficacy of the Insolvency and Bankruptcy Code, and what is the concept of bad bank, and what are the latest developments. So if you like this video and if you think it is adding value to your preparation, please like, share and subscribe. That's it for now. Thank you.